So good morning, everyone, to all of those joining us. I am Tiffany Wu, your Director of Global and Commercial Services at Texas Realtors, and we are so thrilled to bring you a very timely economic update from the esteemed perspective of Dr. Jim Gaines, Chief Economist of the Real Estate Center at Texas A&M. Before we dig in, please note that this webinar will be recorded and posted on our Texas Realtors YouTube channel. Look for it on our global and commercial playlist. We will reserve audience questions for the end of Dr. Gaines's presentation, but do please feel free to type in those questions in the Q&A function. And now I will try and introduce a man that really needs no introduction. Dr. Jim Gaines, he is a friendly face of Texas Realtors and is a perspective that we look to and count on very often, especially in times like these. He has focused on housing and land use development issues with a long career of providing consulting services with firms like KPMG. He shared his expertise with the academic community, spanning from Kent State University to the University of South Carolina, teaching both undergraduate and graduate real estate level courses. Jim has more than 35 years of experience in specialties ranging from research and urban economics, land use and development, and project risk analysis. He's worked closely with stakeholders at all levels of the real estate value chain and is an active educator for programs like the GRI and CCIM. And I have to also mention that Jim has been an integral member of our Texas Realtors Midland delegation, where he meets for 4 days straight with foreign investors from all over the world that have the investment potential in the hundreds of millions of dollars, all to help Texas Realtors share why Texas is such a great place to live and do business. So, Jim, I welcome you so warmly. Thank you so much for your time today, and I am going to turn it over to you.
Well, thank you, Tiffany. I appreciate it, and good morning, everybody. I hope everybody's staying safe and well, and trying, like everybody else, to figure out what's going on. You can see I've led you off here with a couple of several statements, quotes that we've heard from all kinds of folks throughout the textbooks. So on, I thought the best one was irrespective of the politics. About a month ago at one of those daily press conferences, one of the reporters asked President Trump what his economists were advising him about the economy. This is before we even started thinking about reopening. And his response to the question was, they don't have a clue. And I can tell you, it's still kind of that way. And all bets are off on what we're doing right now. The short term is, in the last week or so, things are beginning to look a little better, but that's because they got so bad. We've never experienced, of course, having a mandatory shutdown. Just everybody told to go home, shelter in place, businesses shut down, restaurants shut down, people don't travel. Airplane bookings went down almost 100% back in March and into April, and they really have not rebounded very much since then. Even we're seeing what that effect is on the economy, and you can see it very clearly. But we have no way of measuring it. I can tell you that when we say the economists don't have a clue, they really don't, because they don't. There's no way to model this. There's no way to predict exactly what's going to happen. It's never happened before. It is unprecedented. That's the word that's been used the most. And because of that, we just don't know. My one quick commercial for those of you, I know that this group involves a lot of you that are in the commercial arena. The Real Estate Center has turned its attention here in the last year or so far more to the commercial markets than we've ever done in the past. These are the two major publications. We put them out quarterly, and I can tell you that the one on the right, the Texas Quarterly Commercial Report, is going to come out in the next 2 days, because we just edited it and reviewed it over the weekend, so it's coming. I got to tell you, both the apartment market report, the first quarter 2020, and the first quarter of 2020 on the Texas Quarterly Commercial Report, don't be surprised. All the numbers look good. Most of you are probably very much aware, and we're going to see it. I'm an economist. I'm going to give you graphs and charts here in a minute. The economy was doing very, very well the first quarter. January, February, and the first half, at least, of March, were doing very, very well and showing up in the statistics, which are dominating the first quarter. The second quarter, of course, that's where all bets are off. That's where we're going to see the worst on record. We'd have to see how it's going. If you were not aware of it yesterday, the National Bureau of Economic Research, that's NBER, announced yesterday that February of 2020 represented the peak in economic activity and signaled the end of the record post-Great Recession boom that we've been in. It timed out at 128 months of continuous economic expansion and prosperity. March, of course, became the first down month, and so it officially starts into, and they declared it to be a recession. Most of you are probably aware that the first quarter GDP numbers were down 5%, mainly because of what happened the last 2 or 3 weeks of March. And so officially it went negative. That's not absolutely necessary, but nevertheless, this is what happened. It just was announced yesterday. I hate to start out the whole process here of making this an official announcement. The interesting thing that we're going to have to deal with is this is not going to be a recession somewhat in the typical recession, but the recovery may look somewhat that way. This was self-induced recession. This was not a recession that was caused by a fundamental weakness or decline in any part of the economy. In fact, almost all of the parts of the economy, each segment was going along reasonably well, more positive growth, profitably, etc. Whether it had been manufacturing, services industries, even the import-export, we were getting through all of the trade agreements. That was beginning to balance out. Early in the year, the energy market was even doing okay. Now, that started before the coronavirus, when we had the effect on the price of oil, and I'll get to that in a few minutes. But basically, our economy was chugging along, and in fact, all of the indicators were positive on a year-over-year basis for the first quarter. Again, until we got to March, and then I guess you'd have to just say all hell broke loose. Actually, it's because we just shut everything down, and now we've got the issue of trying to get it back. How bad is it? Worst on record. That's the buzzword going around. The Congressional Budget Office estimated that it's going to cost us roughly about $8 trillion on our economy. They do have a model. Everybody wants to run their model. That's based on what their expectations were without the virus, and now with the virus and adjusting everything and ratcheting it down is the $8 trillion number. It's one of those things that makes a lot of headlines. Not sure how important it really is. The next several things are much more important. Unemployment claims, as most of you are aware, through the end of May, totaled close to 43 million people, almost 27%. Basically, 1 out of 4 people who were working in February and January were not working by the end of May, or at least had filed for unemployment. In Texas, that total is around 2.3 million, and about 18% of the people who were working filed for the unemployment claims. The rate of filing has been coming down, but it's still really, in general terms, it's still at stratospheric levels of going. Oil prices, probably a surprise to many of you, but it's true, have rebounded a lot. Of course, we're aware that a couple of months ago, the price dipped into the negative territory, which was unheard of because the storage facilities were full. But right now we're running, in fact, the last week or two, we've been running about $35 to $40 a barrel. The expectations are that the price is going to stay in this $30 to $40 a barrel range for a while. As the recovery starts picking up here in the coming months, and we'll have to see, but it could even go into that $40 to $50 a barrel range. The energy industry, though, is going to see some fundamental changes. We'll talk a little bit about that. Car sales down, mortgages. Now, in other words, people are being allowed to miss their monthly payments, and this is residential, but it's also happening in the commercial arena as well, where there is some forbearance going on with some of the real estate owners of apartments and particularly retail and some others where that's going on too. We'll have to see how that's going to work out. The deficit, the longer term implications of all of this, quite honestly, we're going to see it and feel it the most at the debt, in terms of debt, and particularly sovereign debt, the national debt and the level of deficits each year. We're going to easily reach, I think, $1 trillion. I mean, that's just unheard of this year. And of course, what that's going to do, it's going to push the total federal debt greater than more than 100% of annual GDP. We've not been better than 100% more than GDP since World War II, since right at the end of World War II, which is kind of understandable. It was around 110% when we came out of World War II, and it took us almost 25 years to recover from that. Here's what we're talking about, those unemployment claims. You can see the trend is obviously downward after peaking there in late March at almost 7 million claims and on down. The latest number about 1.9 million. And I gave you the bars back to the beginning of the year, so you can see the relative position on an average month when things are quote unquote normal or pre-pandemic. Somewhere around 200,000, 250,000 claims a month, or a week rather, would have been normal. So when you're up into the millions, you're at magnitudes higher. When it goes to 2.5 million from 2.4 million, 240,000, you're up 10 times the unemployment claims. So at least that trend is coming down. We're going to have to see how that works out. Again, about 42 million, 20 million jobs, almost 20 million, 21 million jobs lost in April. Here's the biggie. Here's a biggie. They came out with the May numbers here just a few days ago, and we added 2.5 million jobs. So the recovery and the reopening of the economy is now actually showing up statistically. I gotta tell you, not a single economist in the country predicted that. So you can listen to what I'm saying here today, and if I make a prediction, you can see how accurate we are. Not a single economist that was surveyed by any of the reasonable groups came up and anticipated that kind of, first of all, they didn't anticipate a job gain at all. Second, nothing to like 2.5 million. So that is perhaps the good news. If we can, even double that maybe in June, that's going to be very significant in getting us all back online. April, given the gain in jobs, the unemployment rate went down from 14.7 to 13.3. We haven't seen any inflation yet. That I was saying, the debt levels, the monetary policy that's going on by the Fed, the expansion of the Fed balance sheet, keeping interest rates at extremely low levels, And basically, the Fed right now is controlling those low levels, not only for the federal funds rate, the very short-term rate, but if you've noticed lately, the 10-year Treasury is down, has been less than 1%. In fact, was down about a 0.5% here about a month ago. It is gradually creeping back up toward 1%. That will probably happen. One of the interesting things that came out of the Fed Beige Book at the end of May after the FOMC market meeting, the Fed is discovering, and this is one of those issues that's going to affect us in terms of our recovery, and that is that a lot of the workers who are making now a fair amount on unemployment insurance with the additional $600 a week that was part of the CARE program, a lot of workers don't want to come back. These are particularly the service workers, some of the lower paid, the hourly workers, the people working in hotels, the service people, the restaurant waiters and waitresses and busboys, all kinds of people who have those kinds of service jobs that are paying, you know, basic pay per hour. All of a sudden discovered they're making more money being unemployed than when they were working. So some are hesitant. Now that's supposed to give out at the end of July, although right now in the next round of bills being worked on, there's been some discussion of extending that, the unemployment benefit, additional unemployment benefit on out. That's going to be a touchy subject because we really want those people, we want everybody, but we want everybody to have the ability to come back and have the economy working and functioning like it's supposed to be, rather than the government paying people not to work. I'm going to go through a bunch of slides here very quickly. I told you I had charts and graphs coming for you. All of them are going to show you the same kind of things. I'll start here with Consumer Confidence Index, down about 35% since February. You can see it looks like, and it did fall off a cliff because it's dropped so quickly. The good news on the Consumer Confidence Index, this is the overall index that I'm showing you. The Conference Board actually surveys people on about 6 or 7 different things. And one of the items that they do ask about are future expectations. What do you think the next 6 months to a year is going to look like? And that actually has gone up a little bit. People are more optimistic about the future than they are about the current situation. So that's interesting. Retail sales, of course, you're all aware of this. The retail sales have plummeted. This is no surprise as we shut things down. Stores were closed down. Retail real estate has been in trouble here for the last several months with tenants who are scrambling to make rent payments because and if they're not open for business, obviously the cash flow issue becomes a problem. Some of the PPP program, the payroll protection, did allow for the payment by businesses of fixed expenses, utilities and rent being one, but that probably has not been enough to overlay and keep it when retail sales are down so much. The one segment of the retail market, of course, where sales picked up was e-commerce and online business. NFIB, Small Business Optimism Index. This is Main Street. Here's the tricky part. According to the survey by Business Wire, this was early in May. There was the 52% of those that were surveyed expected to be out of business completely within the next 6 months. So the reopening. Incidentally, this index was just released this morning. I didn't have a chance to update this particular slide, but it went from 90.9 there in April. I think it's up to like 93 or 94. So at least it has shown a turnaround and movement back up. Just this morning, that number came out. And so Main Street is beginning to be a little bit more optimistic, simply mainly because now they can open the stores. All of the individual stores are at least trying to reopen, but with of course, constraints and spacing and social distancing. And if you're a restaurant, I think it's been at 25 or 50% capacity and those kinds of things. These things are going to have to get worked through. Manufacturing Industrial Production Index, again, falling off. The largest monthly decline in history was in April, almost 14%. That we expect in may flatten a little bit. It's still going to be a while before that particular index comes back. Interest rates, of course, are always a critical component of a lot of things. Right now, the Federal Reserve is more or less controlling monetary policy and is really affecting the yield curve throughout almost the entire length and breadth. They're affecting not only the short-term rates, but the medium-term rates, the 10-year, and even the long-term rates, and keeping that yield curve pretty flat and low, just a complete dropping of it. That green line there, that's the federal funds rate. They met again last month, and of course it didn't change. The expectations are that they're not going to move on that at all, at least for probably the rest of this calendar year. It would be very surprising if the Fed tried to raise any of the interest rates. You can see the blue line, that's that 10-year Treasury. And the reason that the 10-year Treasury is a benchmark for a lot of different interest rates, a lot of different things are measured against it, particularly in the real estate arena. The 30-year fixed mortgage rate for residential properties, but even for commercial properties, the yield spread on what lenders have to get for commercial loan money is compared to the 10-year Treasury, which is that a little bit longer term than the overnight rate as a risk-free rate baseline for commercial lending. But anyway, you can see that it is down. It has ticked up a little bit. It is now on a daily basis approaching the 1%. These are monthly numbers, so that they tend to lag a little bit. And the 30-year fixed mortgage rate is down now to just a little over 3%. In all likelihood, in the next month or two, don't be surprised to see the 30-year fixed mortgage rate get down to 3 even, or maybe even a little less. In the residential arena, yeah, you can get less than 3% right now with 15-year financing and maybe a 10, 15, 20% down payment and a good credit score. We'll talk a little bit about that, but that's the pattern of interest rates that we're looking at right now. We are setting new record lows, 3.15% last week, as opposed to the monthly number was a record low for the 30-year fixed mortgage rate. Here's something I thought we might be interested in as a group. This is the International Monetary Fund's projection of the world economic conditions. And you can see very easily from 2019 to 2020, it's a world of difference, to make a pun. The world output, the economy changing from a plus 3% to a minus 3%. The so-called advanced economies, United States, European, Japan, and Canada, and so forth, you can see all the way down the line are all negative. The U.S. is expected to have a negative, and this is an annual change in the GDP and growth of about negative 6%. Europe is going to get hit even a little harder. United Kingdom a little harder. England is really having a battle over there to figure out how they're going to get to recover from the pandemic, at the same time that they're executing their Brexit. And then the monetary work over there is affecting what they're doing. The Bank of England and handling their interest rates. Canada about the same as the U.S. So what we're seeing there is across the board negative. The thing that gets your attention, though, is when the emerging markets go negative, because they're the marginal demanders. That's the group of countries at a global level that are generating the net increase in growth and demand for goods and services. Basically, those advanced economies are pretty stable by and large, and don't increase or decrease all that much on an annual basis. But China, India, Russia, Brazil, Mexico, the Southeast Asia countries, when their growth, although it's still reflected as being somewhat positive, like China at 1.2, but China at 1.2, and that's if you believe the numbers, it is not a contributor to the world and the global economy, particularly, for example, the demand for oil. They and Russia and India lately have been producing the net increase in the demand for oil on a global basis. Now, what the interesting thing is here is, though, look at 2021, and you'll see that next year, or the year, next year, yeah, 2021, is still predicted to bounce back, to be very good years across the board. Some of that, of course, is simply because of the arithmetic of measuring change. If you fall down, anything upward looks like a bigger percentage change than it might have otherwise. The biggest problem is, like for the case of the United States, just looking at that, if we fall 6% in 2020 and come back 4.7 in 2021, we're not back up to break even. It takes, if you go down a third, you have to increase almost 2/3, over 50%, in order to just get back up to where you were because of the way the arithmetic works. So the 4.7 growth and 4.5% for all the advanced economies is good, but it really means that it's on out into 2022 before we come back to the pre-pandemic levels of GDP and so forth. Now, the emerging markets, though, are expected to bounce back stronger and harder. All we can do at this point is just hope that's somewhat close to right. We'll have to see. Here's what I was talking about, the Economist. The first quarter of this year, the second level estimate was down 5% for our U.S. economy. Here's just a handful of economists and organizations that have issued their expectations for the current quarter we're in. This second quarter, April, May, June, is going to be, like I had on the title side, the worst on record. It's going to be issued. The average projection is 30% decline. This is what it would look like when we put it out there and look at it after the first quarter. You can see what the prior quarters have looked like for the last couple of 3 years. We've had decent but not exceptional growth in GDP, averaging around the 2.2, 2.3% level, which is decent but not outstanding. We'll have to just see how the exports and imports are even down more than these. They've come in last week. As you might expect, international trade really has cut back with the pandemic. Not a lot of movement there. Right now, I got to tell you, a lot of these numbers are going to wind up, with hindsight here a year or two from now, as just being aberrations. They're going to be abnormalities. Some of you call them outliers if you look at the graphics, because it was such a unique situation to have a mandated shutdown and cut down. Here's what I think the recovery is going to look like. The key to the whole thing, that's the reason I've highlighted the first sentence. The key to the whole thing is recreating and re-employing all the people who have filed for unemployment and who have been laid off and furloughed. Putting people back to work, creating the jobs. That's going to be, and right now there's a lot of speculation that will we recapture, and will businesses recapture and rehire and bring back 100% of everybody that they have laid off, everybody who's been furloughed, everybody who's been affected here by the pandemic, and get them back on the site and get them back working. The expectation is that probably isn't going to happen. It won't be 100%. Now, just how much less than that it's interesting. We won't know. The other key factor is, when you do go back to work, for those who have been laid off and so forth, is spending. And that's even true among the people, those of us who were lucky enough not to actually get laid off and be working from home, as I'm assuming a lot of you are. But our consumption patterns and our spending patterns have changed appreciably here the last 2 or 3 months. We're not spending as much money. Now we're saving. And in a real estate terms, maybe they're saving for down payments to buy a house or do other things, but we'll see. But those are going to be the 2 keys to the pace of the recovery. People getting back to work and what they do with their money and how they spend it. There's going to be short-term, medium-term, long-term. Short-term, this is just my estimate of the timing. The next 2 to 6 months. Second quarter, third quarter. Everybody, a lot of the economists who we're monitoring and seeing what they're saying and our own analyses at the center, obviously second quarter is going to be terrible. It's going to be negative. It's going to be really, really bad. Third quarter, though, if it can be really strong, would mean that we're going to have a stronger recovery and get back. Medium term is more likely 6 to 12 months from now. See what it looks like, and it's going to take that kind of turn. And then there's the long run. The longer run impacts of the coronavirus and what's going on are going to be interesting. And we can talk a little bit about that a little later on. But for example, are we going to have a wave now of more people in the future working from home, telecommuting, teleworking, and so forth? And will that cause businesses to maybe demand less office space? And how's that going to affect the office market, both for development and then for leasing and then for the amount of space that's actually occupied? Whether we have a V, a U, an L, or a W shape, the W is because if we have, and the number of cases have been increasing the last 3 weeks if you haven't been watching it. And we're not sure if it's more cases or just more testing. But if we go into another situation where it appears to be out of hand with the recoveries that we're doing, do we get slapped with another stay-at-home, shut-in kind of order and so on? The job recovery is going to be uneven by industry segments. Some are going to be slower than others. We know that the hotel industry is going to be slow. The airline industry is going to be slower. Some of the service industries can probably pick back up a lot quicker. Not necessarily the restaurants. They're going to be a little bit hurt. One of the things I mentioned a minute ago is just how many businesses actually are able to reopen their doors and stay in business. We'll watch the bankruptcies getting filed. For those of you in real estate, that's a bad scenario. Let me point out, as most of you have probably went through the 2008, 2009 recession and so forth. Anytime you have that kind of churn, anytime you have that kind of damage being happened, people going out of bankruptcies, while it's really tough on those people affected, it does create opportunities in the real estate sector. And so it will be interesting to see how investors, how buyers and sellers, tenants and landlords all react here in the coming year to 2 years in terms of what's happening and development. The commercial real estate is going to be very mixed by type and location. Basically, the industrial warehouse has been doing okay. The apartment market hasn't been hit as hard as we thought. I'll show you that in a minute. Obviously, retail and hotels and motels have been hit very, very hard. And it'll be interesting to see. Restaurants, for example, have always been a high-risk business. Most restaurants, I think the average lifespan of a restaurant is only about 3 years. So those have always been risky kinds of operations. So we'll just have to see. And then location. Obviously, we think that Texas has been doing very, very well relative to a lot of the other areas of the country, and we think that'll continue. The global capital markets, it's a major shift in what's going on. The foreign investment that had been coming to the U.S. has slowed down and dried down a little bit, to be expected. The issue is how it will come back. Let me talk about Texas. Texas looks promising. Really a little too soon to know and to tell about the future, but it's looking better. Like the U.S., our rate of jobless claims or unemployment insurance claims has been declining, but it's still magnitudes. It's still almost 8-9 times greater than the average month that we would typically expect to see. Total filings over 2.3 million people. Here's what we had projected about a 2% growth, or 2.2 to 2.3% growth this year. I throw you out this because it's worthless, because that is what we thought before. It just isn't going to happen. Weekly unemployment insurance claims, you can see in Dallas and Houston, it totaled nearly 500,000, about 500,000, and about 1.5 million in Austin and San Antonio in our big 4 major markets. We're trying to work through that. All of the markets now are at one point or another along the line of reopening. Hopefully jobs are being recreated. We don't have that May number yet, so we'll have to wait just a bit. It always lags the U.S. number. Unemployment rates, you can see, have jumped up well over 12%. Houston up 14%. Houston, of course, got hit with the double whammy. Not only the pandemic, but also the energy industry declined, the price of oil declined. We've learned here in Texas that one of the things, Austin, Dallas, and San Antonio are not as affected by the energy sector as much as they were, for example, back in the 1980s, when we went through similar price and rig count decline and had our Great Recession of the 80s, late 80s, second half of the decade of the 80s in Texas. J.R. Ewing notwithstanding, Dallas-Fort Worth is not an oil and gas town. It's always interesting to me, if you travel around the country or around the world, so many people think that Dallas-Fort Worth is energy related because of that damn television show. It's interesting how that works. Leading economic index is still down. May will be down as well. I can tell you that index that the Dallas Fed puts out is very heavily influenced by the energy industry, so it will be continue to be negative. You can see we went through an oil bust back, in 2014, 15, and early 16. So we've seen it before. We're seeing it again. Here's a mixed news on this one. At least the price of oil, you can see it went down almost on a weekly basis, got almost down to zero. On a daily basis, it was 1 or 2 days it got down to that negative $30-something. But it has bounced back up into the mid 30s and even a little higher, $36, $37. The rig count, though, has come down. The supply of oil, right now we're awash in oil. We've got more than we can use globally. We've got more than we can handle even domestically in terms of storing it. Just where, if you pull it up out of the ground, where do you put it? And all of the storage facilities and tankers, they're even renting trucks, tanker trucks, and just filling them up and parking them on the side in parking lots to store the oil. So the rig count is down really at a historically low number, and we were talking about this earlier this week. Some of my colleagues that we're expecting. This is the Texas rig count, incidentally, not the U.S. This is the Texas rig count. We're expecting this to continue maybe on downward a little bit more. Here's what we think the Texas recovery is going to kind of look like. It'll be staged. Obviously, we've got the phased reopening of the economy. Texas has been one of the leading states in reopening its economy, but it's still going to take some time. Same kind of issues, job recovery, people being brought back to their jobs, and their willingness to come back. We're seeing some of that same issue in Texas that they're seeing U.S. About not being willing to come back to work. Consumer attitude spending, we want to see the businesses back in business versus those that go out of business. And then perhaps one of the keys to recovery is going to be the entrepreneurism Even the people who are forced out of business through no fault of their own, really, they couldn't help it, but use their entrepreneur spirit to get back into it. The energy market is being decimated, it's being changed a lot. There's being a lot of more bankruptcies and mergers and acquisitions. It's not going to look the same here in the next couple of 3 years as it has been here in the past. The Permian is getting settled in. The fracking industry is maturing and is now kind of going through forced go through of the weeding out process and work out so that the survivors are going to be stronger. We think housing is going to be and should rebound reasonably well and could well be the leader in the economic recovery. That's something to watch out for in all of our markets. I can tell you that the May numbers didn't come out too well. I'll show you in a minute. But nevertheless, we're expecting for the rest of the year housing to be very good and to be a economic leader. The thing that's going to be holding back is state and local governments. Every state and local government is going through their annual budgeting cycle right now, trying to get ready for the next fiscal year. They've been hit very hard. Revenues are, of course, been just decimated. Tax revenues, sales taxes, obviously the oil and gas extraction taxes, motor fuel taxes, sales tax on automobiles, transfer taxes, all of the typical sources for tax revenues to state and local government. Now, the ones dependent on the property taxes may not be hit quite as hard because property values, at least so far, have not hit the tax rolls as having gone down, but they're not going up too much. And next year will be the big year for the property tax impact as the market absorbs and figures out whether values are going to go up and by how much and so on. Talking about which, let's talk about real estate. Mortgage rates are hitting an all-time low. Refinancings are set to surge. They're already surging. In fact, we're getting anecdotal reports from a lot of businesses, lenders, that one of the reasons that the mortgage interest rate has been kind of sticky and coming down more than it has is that they don't have the capacity. They just literally don't have the employees and so on to handle the surge of demand for business to refinance and for new purchase loans. So there's no reason to lower interest rates. That's interesting kind of thing. Housing starts have plummeted. They did at least earlier on in February, March, and April. We think that that's going to begin to turn around. That the home builders are beginning to come back and restart some of the things they were doing. April home starts sales took a big hit, and May did. I'll show you. Here's the number. March was the last of the good months. I'm not going to go through all these numbers. You can kind of glance at them. Incidentally, Tiffany mentioned that this is all going to be available to you. And if you would like an actual copy of the presentation, you can contact Tiffany and get a copy of the PDF of the slides so you can study these. But March was the last of the good months in terms of sales levels and so forth. April was down almost 19% statewide. Notice the active listings were down about 5%. Prices were increasing, but not increasing that much. You can see that Dallas and Houston sales were down and listings down. Same thing in Austin and San Antonio. Here's the May numbers. These have just come out here in this past week. You can see that again, sales down about 23% in May. Well, of course, these are closings. When we say sales, that's actually closings. So this would represent contracts that had been signed in March and April. And of course, March and April, people weren't out buying houses as actively. Interesting, the months of inventory has stayed kind of the same, mainly because the number of listings have gone down. So when sales went down, even though sales went down, the listings went down, keeping it still a tight market. This is one reason we expect the housing market to be a recovery and a source of recovery for the economy. We still have shortage of housing. We still don't have enough houses to really satisfy the demand. And once we get through the pandemic issue and we get back to approaching something like a normal flowing economy, we expect to see these numbers turn back around. We're expecting the summer sales season, June, July, August, to pick back up again in some fashion. AD&C, the acquisition, development, and construction lending by banks. This is what triggers future development and future land development. And this is not only true for the residential sector, it's also true for the commercial sector. And I've highlighted the fourth one down, just simply not making any new loans. Almost a third of the banks that were surveyed simply were not making any new AD&C loans. If you don't make them, nothing happens. You got to develop the land in order to have the vertical developments to build anything, whether it's a house or a shopping center or an office building or a new warehouse, no matter what it is, you've got to do that. And then if you look at the ones up above it, especially the reducing the amount they're willing to lend and the lowering the allowable LTV, they're requiring more equity on the part of the developer. And of course, real estate developers are not notorious for having a lot of equity. They rely on financing and leverage a great deal. Let me turn attention to the commercial real estate market. I'm going to warn you right now, all the data that's been released and that we have here is through the first quarter. And that was the reason I was trying to, get across earlier in the presentation. The first quarter actually was doing very, very well. Headline gains in property was up 6.5% according to Real Capital Analytics in April. Little change so far. You can see apartments were in terms of the property price index, were leading the way. Retail has always been the low end of the scale, and then office just a little bit above it. That's going to keep going. Foreign investment coming into U.S. commercial real estate has slowed down a good deal. Again, this will be through the first quarter. And this is a 4-quarter moving average, so it's averaging it out and smoothing it out just a little bit. This is going to take a major decline here for the second quarter, just because everything around the world has slowed down. Everybody was shut down. Everybody was ordered to stay in place. And while I realize that with computer processing and all of the technology that we have, it still gets down to people buying real estate, whatever it is, wherever it is. It still winds up, you want to do it face to face. You want to go kick the tires. You want to go to the property and look at it and check it out, do due diligence and so forth. So not surprising at all. Yield, the search for yield is going to be global. It has been for the last several years. It's going to continue that way. The United States and our commercial real estate in the United States is still going to be some of the most attractive investment opportunities in the world. Not the only one, but among the more attractive. We're going to start seeing some of the foreign investors looking at markets that heretofore maybe they didn't look. The institutional investors are going to move into some of the secondary, maybe even tertiary major metropolitan markets in the United States, because that's where most of the upside opportunity is. If you're going there, right now, they're kind of scared to death of New York. They're kind of scared to death of San Francisco because they got hit so hard. And Chicago got hit so hard with the virus and so forth. No one's real sure how that's going to work its way through the various commercial real estate sectors. On the other hand, if the prices collapse or go down significant, that'll be an attractor. So it'll be interesting to see how this is going to play out. Houston, Dallas, for example, and Austin should emerge very strong on the global scene as being areas of interest to institutional and private investors on the global scene to come to our state and to our major metropolitan markets and look for those kinds of opportunities. When we were at the MIPIM conference last March, a year ago March, most of the people we were talking to, was interesting. The first thing they wanted to talk about was the industrial and warehouse, the logistics market. They can see what's happening there and the opportunities in that market. I think they also, from institutional standpoint, they like the idea of the triple net lease and so forth. So we'll have to see how that plays out going forward. Apartment market cap rates are still fairly down. Again, this is through the first quarter. When we get to the second and third quarter this year, I don't expect that to stay exactly where it is. On the other hand, interest rates are not going to be very high, so the spread on the cost of capital to the yield that you can get from a property may keep the cap rates maybe in that roughly around 6%. They may drift up a little bit. That's a sheer guess. Don't take that one to the bank. The apartment market really hadn't been hit quite as hard. Renters not making the payment, that middle two bars, while it's up a little over 4%, that's March versus May versus March, and the March number hitting 4% was only a couple of percentage points above normal. So it wasn't like people just quit paying their apartment rents at all. And then the apartment owners being late in terms of making their mortgage payments has hit a 2% delinquency rate, which is higher than norm. The norm would be somewhere probably around the 0.5 to 0.7% level. So it is higher, but it's not as dramatically higher as a lot of people had feared it was going to happen. Again, office market cap rates, you can see San Antonio has the highest, is offering high cap rate, high return, a little lower prices on there, whereas Austin, that office market has been sort of the flavor du jour for some time now, and so the cap rates tend to be low, creating a little bit lower yield. We'll have to see how well if Austin can contend. Dallas and Houston hitting in there between 7.5%. And that was, incidentally, that's the overall office market. The Class A market, slightly different. If you want to see it, go to that quarterly market report that I showed you on the second slide. Go out to our website at recenter.tamu.edu. It'll be out here in the next couple of days. I think it comes out tomorrow. Retail market cap rates run a little bit higher. Obviously, retail is a little more risky. Some early preliminary reports that we've seen that some of the malls, and of course, retail market is such a wide spread of the property types, but some of the retail malls have only been able to collect 10 to 25% of their rents. And that's because once the mall closed down, all the stores in the mall closed down and so forth. So they've been affected very hard. But even the freestanding and strip centers and neighborhood centers, about the only ones that have held up, of course, are the grocery anchored. But in many of those cases, the grocery stores own their own store, so they're not tenants. So that's happening a lot. And the retail, what I'm being told in the retail market is that there have been, it's now, the name of the game is restructure the leases, restructure the rent payments in terms of the type, and whether it's fixed rent, percentage rents, and those kind of things, the terms and conditions for that. Industrial warehouse cap rates have held up so far. You can see the general trend on all of these has been the cap rates have been down since the Great Recession of 08-09, and industrial warehouse market cap rate about the same. But Texas is viewed as a very attractive market state for these property types and what they're doing. Again, I can give you more detail on occupancy rates, rent rates, and so forth, absorption rates. If you go to our quarterly report, it would take another 40 slides here to go through them with there. Let me make some general observations and bring us here to some conclusion. Apartment renters actually continue to pay up, and owners wondering how. Some of that is that extra $600 a week on unemployment, because obviously when you think about income distribution and who's renting and who's buying, home ownership versus renter, if you think of the service workers, the lower income hourly workers tend to be renters a lot. And if those are the 42 million, and in Texas 2.3 million who have filed for unemployment insurance and are getting the extra $600 a week, then they do have the resources, they have the money to pay the rent. And rent is generally one of those things you pay because you got to live somewhere. So it is happening that the rent is being paid. We've heard different stories I pilled out that some big investors are amassing billions of dollars in rescue capital. They're going to go out and if you're buying troubled real estate, you may or may not directly buy the real estate. You may just buy the debt and then take it. But so it'll be interesting to see how the structure within the commercial real estate arena, in terms of the opportunities that are coming along, how that's doing. But we are hearing more and more reports of private investors and some of the institutions beginning to think in terms of having the resources and the capital resources to go and look into the market with the expectation of coming up with some opportunities around the country. The CMBS market, the commercial mortgage-backed securities market, had a massive spike in delinquencies, the largest month-over-month increase. What you need to know is that the purchase of CMBS bonds has been included in the Fed asset purchases. So the Fed is going to kind of backstop the commercial mortgage-backed securities market to some extent. Remains to be seen exactly how much, and we'll just have to see how that works out. So it won't be quite as much blood on the street, at least on those. Now, we all know that the CMBS market does not include a whole host of commercial real estate financed properties. So it's just that one segment of it. It's generally more higher grade, higher cost stuff. Real estate yields are going to still hit new lows this cycle because of the downplay of the pandemic effect, and yield and search for yield is still going to be the key to the whole real estate market at a global level, at a domestic level, as people come in. On construction, we are hearing that developers are increasingly halting or canceling scheduled starts. They're completing jobs and completing projects that are already under construction and that are already underway. But doing the next phase or doing the next project is right now on hold. There's some disruptions, both in terms of materials and workers and on the labor front, that creates some shortage, that suppliers are warning of late and canceled deliveries, which of course, and a lot of people forget about it, but part of construction cost, the cost of development, is time. You just can't afford the lost time. And incidentally, that's going to start showing up more and more too, as it takes longer and longer to get inspections and permits and zoning approvals and so forth. If the public sector has to cut back on its staffing, we found that in the 08-09 recession, when the public sector's cut back on the staffing, say at the city or county level, it just slowed everything down for getting projects and getting deals through the regulatory process. Time is a cost, and unfortunately, most of the public sector workers and the planners and the people who work in the public sector for the cities don't think of it that way. They say, well, yeah, we're going to give you you're going to get your approval, but it's going to take another month to do it. Well, that's another month of carry and another month of cost. We just have to see. Let me wrap this up. One of the things that we are not sure of is how much the forbearance program that's going on around the country, both for residential and non-residential properties, how many of those are going to translate into foreclosures down the line. We've had moratoriums on foreclosures. We've had moratoria on evictions, although I think in Texas that's now been lifted, at least for the apartments. But it's still not clear. The businesses that and other retailers and so forth who maybe have been given forbearance on making their payments, say on mortgage, if they bought the property, they own the property, are they going to ever be able to make it up, and how are they going to make it up, and what are the terms and conditions and the costs going to be to make it up? We do, you can see it coming that low interest rates are going to be with us for the foreseeable future. And in these economic times, the foreseeable future is sometimes not more than about a week. But anyway, for some time to come, we're going to be seeing low interest rates. They are going to stimulate demand, residential and non-residential, particularly as jobs come back. But the key is going to be, are lenders going to lend? We saw the AD&C financing. I can tell you, even on the permanent financing, lenders have reverted back, and the regulators are forcing them to revert back to the very conservative, low-risk loans. They're making what I call the vanilla loans. The QM, if you're on the residential conforming loans, and this is carrying through also for commercial real estate. They're going to require greater debt-to-income ratios, probably greater down payment. They're even talking about recourse loans instead of non-recourse loans, tying properties together, cross-collateralizing, all of these kinds of things that just simply makes the lending tighter, more difficult, not as open and as freewheeling as it has been in days in the past. The business practices of development, construction, brokerage, sales, property management, everything is adapting, of course, and this is now being accelerated because of the experience that we're going through here in the last few months, and probably through the next several months, is accelerating the application and adapting of new techniques and new technologies and new processes and procedures for how to do things and what to do. Things like office design. I do get information from architects on a regular basis, and they're rethinking the whole open market or open space concept of offices and so forth. Are going to have to go back to the cubicles or enclosed offices. How is that going to affect the total space demand? Houses, home builders are thinking in terms of, okay, I got to build houses now. People may not want a dining room, but now they need an office. I'm sitting in mine. I happen to have an office in my home. And the smart house. You got to be wired. I made the speculation the other day that one of the outcomes of all of this, I think there's going to be another wave of demand for public Wi-Fi to make it a public good and just make it universally available because of the education system. How many of our children were forced to have to go to online education but couldn't do it because where they lived, they couldn't get Wi-Fi, or their parents couldn't afford to buy broadband Wi-Fi coverage for their house. This is going to have to become, we're going to have to rethink the nature of that particular industry. These are the kinds of things that are going to be coming along in the future, that longer term impact of the pandemic, and see where we go. Home construction, again, in the housing market could be prime recovery. It's well suited to do it, and it needs to be. We need to have every economic boom needs to have the driver. Texas had a driver here since the Great Recession in terms of hydraulic fracturing in the energy sector. Well, that's not with us anymore in terms of being the driver forward for our economy. But the housing market could fill that bill, and could fill that bill nationally as well, or at least be one of those industry segments that helps become the driver of the economy. The commercial real estate investment market is probably somewhat on hold. I'm aware there are deals still being made. There's still properties being bought and sold. but by and large, a lot of it is a little bit on wait and see. Got to be able to get more mobility and being able to get out and about. Again, the technology and the processing, so forth, of using virtual tours or online closings and that kind of thing is fast evolving and could come into play. But we've got to see how it's going to play out with the reopening, if we will, of the economy and getting everything back into the flow of things and going on. I do appreciate your attention. I've got to tell you, doing these kinds of presentations are kind of weird, because I'm sitting here, I'm talking to my computer. All I see is the slides. I can't see your faces to see if anybody's even paying attention or listening or whether I'm getting through. So I got to tell you, this is one of those technological changes and the way the world is working right now that's so different to make these kinds of things together. So Tiffany, if we've got some questions, I'll be more than happy to try to address them.
Yes, thank you so much, Jim. We've gotten several questions that have come through. One is, can you speculate as to whether there may be any sort of grant program or assistance for first-time home buyers, like some have seen in 2008 and 2009, or any sort of programs really for all buyers and sellers?
Well, the first is, yeah, there may be some extension of down payment assistance kinds of programs. Could well be the case. My guess would be that we will see relaxing or incentives offered to the banks and the lenders to make loans to first-time borrowers and to reduce the risk to those lenders if they sell the loans into the secondary market and don't have to worry about buyback. That would be one of the big incentives. Also, the risk rating of those loans for reserve requirements by the banks or the mortgage companies. FHA, as you well know, have in the last several months actually have tried to make first-time home buyer loans easier in terms of credit score requirements, and of course it's only a 3.5% down payment anyway, and you can finance that. So FHA has been doing it. What's happened though is that the lenders are overlaying requirements on top of what FHA requires that are more strict, and so some of those advantages that it looks like the first-time buyer might be getting get kind of taken away. They've got to figure a way to not have the lenders put those on there, because if they sell the loan, for example, to Jenny Mae, and the loan goes bad, Jenny can force back a buyback on the loan. So I think you'll see some things like that coming into play. We may see some relaxation, although I don't think this is going to happen real quick, but some relaxation on income levels, debt-to-income ratio numbers on the part of the lender looking at a first-time buyer and their job history. Everybody's job history, or at least a lot of people, their job histories have gotten interrupted. The other side of the coin, one of the things that we are paying attention to and hearing some preliminary reports about, one of the things that has happened here in the last 3 months with basically the economy shut down and the shelter in place and stay at home, obviously the amount of spending that I showed you the graph earlier, retail sales going way down. The personal savings rate has gone way up. It's gone up. It's about 13% now, and from about 6%, almost double. People are saving money in the course of some of this. At least some are, so coming out of this here in the next couple of 3 months, I think there's going to be some pent-up demand, and people may discover that they have another $1,000 or $2,000 or $3,000 that they can put toward a down payment that they didn't have and really had no intention of having. Also, let me let me very quickly add to the answer to that question. There's a big difference between a first-time buyer and an entry-level buyer. The entry buyer is typically, and I can tell you statistically, is a younger buyer just getting started in their career, trying to get out and buy a house. And those are the buyers that typically have the biggest problem because they have no savings. They may or may not have a really good credit score, and of course they won't have much of an employment record. As opposed to the first-time buyer, who I can tell you again statistically is a little older. This is the older millennials, and in fact, if we get into the demographics, I can tell you it's that 33 to 38 age group. Typically, they have more of an employment history. They've been working longer. They do have savings, as I was just describing, but they've been renting and now have decided to go into the home ownership market. So two different sets there, and you do need to differentiate a little bit between that entry-level buyer and a first-time buyer. First time is just first time, as opposed to entry, who is just trying to enter into it as a younger. Sorry, that was a long answer to a short question.
Well, Jim, we also have another question. What is the forecast for affordable housing?
What we have seen here lately is the rate of increase in home prices has slowed down. A year or two ago, we were running into the 6 to 9, and in some of our market areas, 10% area. And of course, this is all spotty. Everything I'm giving you and saying to you here is extremely generalized and just broad brush. All of you can think in terms of the neighborhoods that you know about in your community where some of the values have exploded 10, 20% in the last few years, and some of them maybe have gone down. But across the board, we were looking at home prices going up anywhere from 6 to 9% across the board. That's now running in the 3 to 4, maybe 5%, but really more the 3 to 4%, 4.5% level. So in terms of affordability, we're not seeing the push up. The big problem, income levels have not gone up proportionately as fast, making it a little bit less affordable to buy a home. And as I pointed out a little earlier, we still basically have a housing shortage. We've still got high demand, relatively low supply, and it's just economics 101. When you have that kind of situation, you get higher prices. The good news on this, though, the home builders across the board as an industry group have discovered that the high demand is in the lower end price category. For Texas, talk about anywhere from $180,000 to about $320,000, depending on the local market. And the home builders have been really, really pushing to be able to develop and build product and deliver product in those price points. Now, the trade-off there is you may get a smaller house. You may get the house on a smaller lot. It may be a little further out from town so that the land cost was a little lower. It may not be in the city limits. Those are the kinds of trade-offs, but the industry is trying to accommodate where the bulk of the demand is, and given the income distribution of Texas and most of our communities, that is where a lot of the demand is in that price category.
Thank you, Jim. So we are running a little short on time, so I will synthesize it to just a few more questions.
Okay.
Do you think that the Fed may ease existing tightening of loan qualifications, specifically for housing development and construction, to help stimulate the economic recovery?
The Fed won't do it. Some of the regulatory bodies, FDIC, for example, SEC, some of the banking, Federal Home Loan Bank, there's a whole array. I think there's 8 or 9 alphabet regulatory agencies that oversee the banks, and then all of this is going to stem out of the Dodd-Frank bill or law that came out of the Great Recession. So yeah, we'll probably see some regulatory oversight immediately. Back to the earlier question, it may be to ease things up, but then at some point they're going to get nervous about the risk exposure to the banks.
Gotcha. If you had to bet, even though I know your presentation says all bets are off, but if you had to bet on one of the 4 Texas cities on your presentation to lead the recovery through residential real estate sales, which one would it be?
Oh, Lordy. To lead in residential sales in terms of the gain in sales?
Right, to lead the recovery in that sense.
It's going to be a close call between the Dallas area and Austin. And that's going to be a pretty tough call to make. San Antonio has done very, very well. Percentage-wise, Houston will look good because it has been down a little bit because of the energy issue. So percentage-wise, we may see that interesting. The good news to answer that question is all of them we think are going to do well.
I like those betting odds, Jim. So
did I cover myself on that answer?
I think you did perfectly. So I'm going to just unfortunately have to share just one last question because we are so tight on time. So finally, Jim, as we continue to recover, do you see potential for resuming and potentially seeing an increase in domestic migration to Texas?
We will probably continue to have domestic in-migration. We're going to still continue to be an attractive area and an attractive state for people coming to Texas. I suspect that it's going to slow down. I mean, we just had an incredible boom and an incredible number of people moving to Texas every year for really the last 10 years. It's been absolutely incredible. I do think that will slow down, but that doesn't mean it goes away or it doesn't become negative. It's still going to be positive. It's still going to actually be strong. And actually, it's going to give us a chance, maybe, to keep a little bit better balance in the housing market and in the retail markets and in the commercial and in the job market to keep that balance in there so that we don't get all of a sudden an overflow of people without being able to accommodate them and so forth. So yes, I think we are still going to have very positive domestic migration. The state is still attractive. We still have no income tax. We have actually low tax burden across the board. And I know everybody will argue with me about the property tax, but total taxes on a per capita basis in Texas is still quite low relative to the rest of the country. We still have very aggressive, positive business, entrepreneurial attitude at the government level and so forth. That may change over time, but at least for right now, we still enjoy that reputation. This is an easy state, relatively speaking, to do business, to create a business, to maintain a business. And we got the best Tex-Mex food in the world.
Couldn't agree more, Jim. Well, thank you all so much for joining us. We had incredible engagement on this webinar. Jim, seriously, always just a testament to the valuable information you're able to share with us. Sincerely apologize for the questions we were unable to get to, but this webinar will be recorded. It will be posted on our YouTube channel, and the slides will also be sent in a follow-up email to all those that registered. Jim, thank you again. Appreciate your time. And for everyone on this call with us now, we'll see you at the next one. Take care.
Thank you.